Hello everybody and welcome to Volatility Trading Strategies. So in this video I'm going to go over what we call the Tactical Volatility Strategy. Now we also have one called the Tactical Balanced, which trades traditional asset classes like stocks, bonds, and gold, and I encourage you to watch that video as well. But today I want to go over the Tactical Volatility, which trades the volatility products XIV and VXX. These have been released in the last 6 or 7 years. Now both of these strategies are designed for people who are looking to take a more active role in their own investing. Now, why would anybody want to do this? Well, the truth is, we have a lot of data that shows that the vast majority of fund managers out there, financial advisors, hedge fund managers, the majority of the mutual fund industry, they tend to underperform their benchmarks, and they certainly underperform the S&P 500, which on its own doesn't perform that well either. So there's nothing wrong with people charging money for their expertise, but the reality is that the majority of clients out there would be better off trading their own money in their own accounts, just investing in simple index funds. Now, in order for me to compare my results, we're going to have to establish some kind of baseline for a fund that people could invest on their own without paying anybody any fees. And then I can add my own results and we can see if there's some value added there. So I'm going to open up my computer and we're going to get started. Okay, so as far as a long-term buy and hold investment, this is the one that I've been giving out for many years now. So this black line is the S&P 500, and since I would never recommend people put all their money in the stock market, I've created this blue line, which is 50% stocks, 25% bonds, and 25% gold. Now, all three of these are low expense ratio ETFs you could just buy in the long run. And over time, it performs more or less the same as the stock market. But the benefit is, because it's diversified, it performs better when stocks take a nosedive. So here's the financial crisis in 2008 and 2009. Performed much better through there. Here's the European sovereign debt crisis. Stocks took a serious hit there, and this balanced portfolio did quite well. And more recently, in August of 2015 and early 2016, it was a little smoother as well. So obviously, you're not going to get rich doing this, but it's a pretty good option that serves the purpose of not paying anybody any fees. So the reality is, and a lot of my peers are not going to want me to say this, but this fund in the last 10, 20 years, and probably going forward, has outperformed roughly 80 or 85% of the financial industry. Now, obviously there's a lot of good people out there, very smart people, doing really great work, so I'm not making blanket statements against the financial industry, but we have to be aware of this reality that actually buying index funds has outperformed the majority of them. So I'm not a buy and hold investor. I'm not trying to just track the markets. I'm trying to substantially beat them. So now what I want to do is compare my results to this, and I want to show you the exciting things that I've been doing with some of these volatility products. Okay, so I'm actually going to go through my own results quite quickly here because as fantastic as they have been, and you're going to see that in a minute, what I've done in the past 5 years doesn't really help you starting today going forward. So I want to spend the majority of time in this video explaining how the strategy works, explaining why it's going to continue to work, and that will help you. So let's get into the results anyway. I'll do this quickly. You can see this in much more detail going through the website. But this green line is the VTS Tactical Volatility Strategy. The black line down here, which looks like kind of a flat line compared to my results, this is the S&P 500. And we use that because, industry compliance laws and whatnot. But the 50-25-25 fund might be actually slightly above that in the long run. And of course, your average fund manager might be slightly below that. But this is the results for the strategy. Now, just to put some numbers to that chart, you can see that we've quite handily outperformed our benchmark. The headline number, the annualized returns, of course, are substantially higher. Now, I would encourage people to not get too hung up on annualized returns because that doesn't always tell the whole story of how consistent a fund has been and how good of an investment in the long run. So what you really want to look at is the Sharpe ratio and the Ulcer Performance Index down here. These numbers are also exceptionally high. So that shows that the strategy is not only performing very well, but it's also very consistent from month to month. These take into account the standard deviation of your returns. So if you're having huge wins and huge losses, you might still show a very high annualized return, but you're going to suffer in your risk-adjusted measures. And my strategy, I focus much more on these down here rather than just the headline number of annualized returns. Another very big benefit to this strategy is you can see the correlation to the S&P 500 is very low, only 27%. Virtually anything from plus 30 to minus 30 it's considered not very correlated. And I don't know about you, but my gut is telling me that something maybe not so pleasant is brewing in the world, the global economy right now. So the fact that the strategy is doing so well, but is at the same time uncorrelated to the stock market, this is going to help us going forward. So enough about the results. Again, you can go much more into detail on the website. What I really want to do is show you why this strategy works. So the strategy is called tactical because we will only ever be holding one position at any one time. And there's really only three possible positions that we could take. The first one is the XIV. This is a volatility ETN that tends to profit when the markets are going up, so during a bull market, for example. And just as a side note, this is the third longest bull market in history. So this product has done pretty well on a terminal results level. On the flip side, the VXX, which is essentially an inverse product, it does well when the markets go down. So you can see this spike here. This is during the European debt crisis, and it can go up substantially fast if markets crash. And then if our signals are not strong enough to take a position in either one of them, we hold a cash position. And cash actually represents about 50% of our strategy. Now, looking at these two pictures, you might be wondering why anybody would want to trade either one of them. Even the XIV, which is supposed to do well during a bull market, we've seen some excruciating drawdowns along the way, from 20 to 5, and more recently from 50 all the way to the teens. So this would be an emotional roller coaster, and there's no reasonable investor who could hold this thing in the long run. And on the flip side, the VXX, this is an utter disaster, of course. These are split adjusted prices. But, from 900 down to the teens, that's not a misprint. This thing is down over 99% since it launched. So looking at these two pictures, you might be wondering why anybody would want any part of either one of them. But there's actually a very specific reason why these products offer such a great investment opportunity for those who understand them. So unlike stocks and bonds and gold and all the traditional asset classes that derive their price based on supply and demand, these products don't. They're very unique in that sense. So these products derive their price based on a known formula, a known system of rolling the front 2 months of the VIX futures term structure. So if you've never seen what that looks like, this is the VIX futures term structure. You get a front month price, and then every month after that, there's an expected future price. Now you can see similar things in the oil market and the bond market with a yield curve, but this is for the market volatility. Now, these products derive their price based on a rolling of the front 2 months of this futures term structure. So one of them, for example, would be buying this and selling this one, and every day they're going to be buying and selling the front 2 months. The inverse product, the other product, would be doing the opposite. It would be selling the front month and buying the second month, and it does that every day. And it's this rolling of the front 2 month futures that's actually creating the prices. That's what's driving the net asset value of the ETNs. Now, this is great for us because we don't have to predict individual behavior. We just have to compile a list of indicators that allow us to be predicting what this curve is going to look like and what effect that's going to have on the products themselves. So we can turn these two products that on the surface look like quite a disaster into something that looks like this. Now, this is a video, of course, I can't see your face, but if I could, you might still have a little bit of a confused look on your face. So what I'm going to do now is I'm going to go through a little presentation, and I think this is going to nail the point home. So I've got a slideshow here. I'm not going to play it as one because I want to use my pointer, but I want to show you visually what it looks like when I'm adding my indicators as we go. So we're going to go from this, which nobody can hold on to what you see on the website. So the first indicator, of course, is the VIX futures term structure. Like I said, if it's upward sloping, it's a little bit of a tailwind for the XIV, and you could buy that. So this is a little better than the buy and hold. Buy and hold goes from 25,000 up to 75,000. This person, 25,000 up to 100. But again, excruciating drawdowns. You could never hold this. So we have to get smarter. The first layer of signals, we would look at the mean reversion. You could check the VIX index prices themselves. You could track the momentum of volatility from day to day, and it does improve the results a little bit. So we're going from 25,000 now to 150. But again, these are 50% drawdowns, and we want no part of that. So layer 2 signals, this is the VRP, the volatility risk premium. The VVIX, which is essentially the volatility of the VIX index. And the VIX standard deviation is also important. We want to know how much the VIX is actually moving around in recent days. And when we do this, it improves even more. So we're going from 25,000 again up to over 200,000. Still, the drawdowns are too large, but it's starting to resemble something that a long-term investor could be interested in. We're going to add a third layer of signals now, the VIX term structure. The 30-day convergence is important because, again, it's buying and selling the front 2 months of the future, so we have to know what's going to happen as it converges to that spot VIX. And then the VXV is essentially, the VIX index is a 30-day index. The VXV is just a 90-day. It's the same thing, but it's very important. And now we're getting into something that long-term investors can get excited about. But because I'm all about risk management and preservation of capital, I want to get even smoother than this. So what I add is what I call the smoothing layer, where I tighten up all the signals and tighten up all the indicators to the point where I'm only taking 50% of the market. And anytime the markets are ambiguous and giving mixed messages, we're just going to leave those signals on the side and move to cash. Now the smoothing indicator takes us from 25,000 up to 500,000 and reduces the drawdowns greatly. So this is essentially how I've been able to reduce drawdowns. Now on the blog section, there's an article called XIV crashes of 10% or more. The XIV has actually crashed 10% or more in a single trading day 32 times since it launched. And my strategy, because it's so safe, has avoided 29 of the 32 biggest crashes. So that's essentially what I get excited about. The annualized returns are fantastic, but what makes me happy is how smooth the curve is. Now, this is only the XIV side of it. This is only the short volatility. So we're going to add in the VXX, which is the long volatility. That's the one that's going to save us if there's another financial crisis. When we add that in, this is what it looks like. These are the final results on the website. So watch this chart again as I go through the buy and hold all the way down to what you see on the website. You can see it develop over time from here to there. So that's essentially the strategy. Now, like I said, I'm not selling you the past. I'm not trying to sell you on what I've done in the past. I'm trying to tell you that because I'm only taking 50% of the strongest signals and I'm compiling data from so many different sources, this is actually the reason why the strategy is going to perform very well going forward. So that's my presentation of the VTS Tactical Volatility Strategy. If you have any questions at all, feel free to contact me at any time. You can go to the subscribe tab on my website, scroll down a little bit, and you can see that there's a newsletter. Just put your name, email address. You're going to get all my blog articles and videos sent to your email, so you're never going to miss anything. And if you did like the presentation and you are ready to subscribe, this is the VTS Tactical Volatility in green here. We do have other strategies as well, but all of our strategies offer a free 2-week trial, so you can do this risk-free. You could trade it in a paper trading account if you wanted to not risk your money right away. Whatever you're comfortable with, I just want to make sure that you try the strategy out, see if it fits in with your long-term investment goals. And lastly, of course, I'm brand new to YouTube. I just started doing this, and it's really not easy, so please subscribe to my channel so I can put out more videos and I can try to get better at this. So thank you for watching, and I hope that very soon I can welcome you to Volatility Trading Strategies.